Hello, everybody. Welcome to Talk About Houses. I'm Todd.
I'm Juana.
Today we're going to talk about the difference between a market crash and a market correction. The truth is what's the definition of market crash? Like, what does that even mean?
So this is one of those things where if it walks like a duck, it quacks like a duck, it looks like a duck, it's a duck. But I only know it when I see it, right?
Right.
So there are no hard and fast numbers for a market crash versus a market correction. But of course, we all know it when we see it, right?
Yep.
You and I have had this discussion over the years quite a bit, and we've kind of come up with our own kind of broad definition of what that looks like. And we think that we realize that over the past couple of years there's been this massive, upward trajectory for prices for real estate. But I think it's going to take more than a leveling out or even a dip for it to be either a market crash or a market correction. I think we're going to have to maybe put some benchmarks in there to give us some perspective. So if the market goes to a level where the house was worth, let's say, a year ago, is that a market crash or market correction?
Correction.
If the house is worth what it was worth 2 years ago, market crash, market correction.
Correction.
The house was worth what it was worth 3 years ago, market crash, market correction.
Probably a crash. If it goes below, that's my rule.
Okay, so if it goes below the 3-year benchmark.
Right, and this is why. Let's say median home prices are $300,000. Okay, and you buy a house for $300,000.
Okay.
And in the course of 4 years, they go up to $400,000. They go up 100 grand. So they go up, $25,000 a year, right? Which is less than 10%. But then something bad happens and the market goes down to 325. Well, that was clearly, you bought your house 4 years ago. The house is still worth more than you paid for it. But 3 years ago, it's worth the same. So I think that's the number. And this is why I use that number. Because unlike most equities, real estate the value of it's really not relevant. It's actually not what your house is worth, doesn't really do anything to you, right?
So you only care about the value of your house twice, when you buy it and when you sell it. The in-between is just noise.
Right, it's noise. So the fact that, now obviously there's only one time the real estate market has crashed nationally that we can actually count on. There have been individual markets that have been wrecked, like Detroit has been completely wrecked over a long period of time. Baltimore had basically a real estate crash at one point in the 70s and 80s, which has recovered. The downtown areas. You've had downtown areas crash and recover based on demographic shifts and things like that. But there's only been actual one real estate market crash. Right. And that was the one we had that caused the recession from 2008 to 12, you could say. But the home prices started collapsing in 2006. And they collapsed below what the reasonable trend of home values should have been. So home prices trend up at 4.6% per year. So just because the market softened a little or whatever, that's not a crash. And certainly the prediction, and we just did a video on this, but the prediction for home price appreciation this year is still 14%.
Right.
15%. And they're looking ahead with the Feds raising rates.
Right. And that's nationally. So it could be that in your market, it's 22%.
Austin or Miami.
Right. So nationally, they're looking at about 15%. The other thing to keep in mind is that we're talking about a crash versus a correction, but a decline is a totally different animal.
Yeah. So here's the bottom line. The price of real estate is 100% driven by market forces. That's what's driven by. Now, the crash of the market that we had previously had two major false forces that were pushing up the values. One was, and it was too easy to get a loan. It was way too easy. Anybody could get 5 loans to buy 5 houses. That's clearly unreasonable. That doesn't exist today. It's not possible. Okay, but what that spawned was this other thing where builders were artificially overbuilding like crazy. They were literally small build. So we know somebody who was a small builder, private builder. He just was building. It wasn't a national company. He had 8 subdivisions building all over town at the same time. And it was all leveraged. He had gone out, borrowed money to buy the land, borrowed money to build the houses because he was going to make a killing because home prices were going up. He could sell homes. And then the people buying the homes were investors from out of state who were basically coming in going, okay, we want to buy the house. We're not going to rent it out. We're just in the 9 months from the time it takes us to put the contract down. We're going under contract at 260. In 9 months, this thing will be worth 400 or 350. So we'll just put it on the market and sell it and take all the profit. And all we'll do is we'll get a loan at closing, and then at closing we'll just flip it, put back in the MLS and sell it. And that worked for about 2 years. And then all of a sudden, that lender market went away, and people weren't able to get the loans. And then next thing you know is there's all these investors who have bought all these new home build flips, which is predominantly what crashed the market in most states. New home builders like crazy, building an irrational number of homes that didn't have enough people to go in them, flipping them to other speculators. And what happened was that artificial, artificial demand was fake, and it pushed up the prices of homes. And when that went away, you didn't have anybody to buy the home. So you had it. So I'll give you an example in Vegas. And this is why when we talk about inventory, why it's important. The crash of the market in Vegas was because we had 26,000 total homes, condos, and townhomes in the MLS. 26,000 at the time, and normal market was about 7,500. And right now we have about 1,500 homes, just homes, and we have well under 3,000 when you look at total, but it's less than that. So prices being high themselves don't cause a crash. So supply and demand make the price. In the case of the last crash, we learned 2 important things. Builders got skittish about overbuilding, and this wiped out a bunch of builders. And then the other thing is the lending things changed. So we've kind of wiped out. Now there's other factors causing prices to rise. They're not necessarily false unless people decide, I just moved to Texas and I hate it here. I want to move back to San Francisco, right? I'm going to move my tech company, and we're all going to go back to paying California state income taxes and move back into the city where median home prices are 2.6 million. So we can all work at headquarters because we hate Austin and, barbecue. Right?
Right.
So this is why we're sort of bullish on what's been going on. This is a shift. And we think that, if we thought the market was going to collapse, we would go sell a bunch of houses. We would call our investors, tell them to sell all the houses. But what I think is going to happen is I think that the interest rate rises are enough that's going to cool the market. Inflation has to stop too, because the problem with inflation is inflation will force real estate prices higher, because the more inflation we have, the more people are going to flood to real estate. And then I think Wall Street needs to stop buying in the housing market.
Well, okay, so I agree with you with all of it except the last part.
Wall Street?
I think that Wall Street is actually what supports the housing market, because those houses are not going to churn. Now, I think that from a perspective of individuals owning houses, I think that's obviously problematic, because those houses will not churn, and they are effectively removed from the market for long term.
Oh, you mean hedge funds? And
right.
Wall Street, not individuals.
Right, not individuals.
No, right.
So when I like picking on BlackRock, but so when BlackRock buys all these houses, they are effectively taken off the market long term, much longer term than individuals owning them, whether they're individual investors or homeowners. And so those houses will not churn the way the rest of the market does. And because that inventory is effectively removed long term, that supports the price of real estate, but it also lessens the available inventory for churn for regular people to purchase and then go ahead and sell when they're done with the house. So I think that is a little bit problematic, but I do support the hedge funds and the institutional investors purchasing these homes, because, like I said, I think that they provide support for the housing market. I think They tend to be good stewards of the houses in the sense that they maintain them. The neighborhoods look nice because they own the whole neighborhood, so it's in their interest to maintain the whole neighborhood. I think that they provide a valuable service as far as having decent rental properties for people to rent. I think people need to rent properties for whatever reason in their lives that they're not homeowners and they need to rent. I think that's a very valuable social service. So I am very, very much fond of that, and I think it's a good thing. But I think that builders need to keep a better feel for what's going on in the marketplace as far as the availability of inventory, and build the right amount. We're in a position now where builders have not built the right amount for basically a decade. And so because of that, we're well, not just because of that, but that's one of the reasons why we're in the situation where we don't have enough housing. I'm not suggesting that builders overbuild the way that they did before, but I am suggesting that they fine-tune their metrics better so that they can keep up with demand so in such a way that it's supporting home prices, it's providing sufficient housing, and it provides for a stable housing market. We are very fond of a stable housing market, not one that's a roller coaster.
Here's the ultimate difference and problem that we have at the same time. The previous run-up was based on a different thing. This run-up is strictly based on shortage. The shortage cannot bubble. You can't bubble a shortage. You don't have enough. It would be like, is Tesla stock a bubble? Well, guess what? Those people aren't selling, right? They're not just going to sell their Tesla stock. You can't say that it's going to collapse because prices are high, because you don't have, how's it going to collapse? You have to have, the only way for the market to collapse is you have to have a ton of sellers and not enough buyers. And we have the opposite problem. And it just doesn't change overnight. These are things we can see for a long period of time. The second problem is that as long as we have Wall Street, we do have a housing crisis from a perspective. It's getting harder and harder every year for just people like you out there who are just trying to buy a house and learn about real estate, that you're seeing prices go up and thinking this is getting out of reach. Because the problem is you're competing with Wall Street, who says, hey, we're bullish. We think it's going to be great for 10 or 20 years. We're just going to collect rent on you. And we're going to buy the houses and then rent them out. And a lot of people that could have bought in the past are going to go and turn into renters, or that should be buying or should have bought 2 or 3 years ago, are just going to go be renters. And I think we're going to create two types of people. We're going to create lifetime renters and then super rich people. And there's a graph, you can probably Google this and find it, but it's a little misleading, but it basically says that the average net worth of people who own homes is 55 times the average net worth of people who don't own homes. Now, it is misleading because people who own homes tend to be much older and they've had a lifetime to accumulate assets, right? And then people who don't own homes, renters, tend to be younger and tend to have not had much. They're still in that phase where they're like just trying to get by and they don't have a lot of personal wealth. But there is something to be said, because most people, the single most valuable asset they own is their equity in their primary residence.
Right. So I have another take on all this too.
Okay, what's your take?
We do have all of these institutional investors like BlackRock who own all these homes. Now, my position on this is that yes, they will hold on to them long term, but not necessarily in the way people think. I envision that within 10 years, they will start to slowly but surely roll these homes over to purchasers, and those purchasers will be the existing occupants.
Okay.
I think what the end game is going to be is they're going to offer the existing occupants the opportunity to purchase the home. Now, here's the way that's going to work, is they're going to incentivize them through a rent-to-own program. And I think that's going to be slowly over time to where these homes will not come on the market. So I want to differentiate this. They're not going to put these homes on the market in onesies or twosies, but I think that they will have programs that are rent to own. Now, what rent to own is going to do for BlackRock and people and companies like that is it's going to allow them to have significant rent increases. So they're going to collect more rent on the front end. Part of that rent will count toward the down payment for the purchase price. And if the people don't purchase the property, then they get to keep that money. And if the people do purchase the property, then that property is purchased, if you will, kind of off the grid. And so it still keeps real estate values very, very steady. So I think that's going to be something to look for. It's going to be another source of income for them. And they're going to probably, at first, either finance those themselves or finance them in partnership with some other entity where they're still getting a piece of the pie. So they're going to turn these rentals into multiple income streams because it makes a lot of sense.
Okay, this is what I would do. This is how I would do it if I was going to get all these houses.
Okay.
Let's say you have a house where and forget what the price of the house is, but the market rent is $2,000. Mm-hmm. And let's say that if they bought it right now at whatever existing price it is, they could go get a mortgage payment for $1,800. Mm-hmm. So they could, and we just did a video on this, in 57% of the country, mm-hmm. it's cheaper to buy than rent. It still is, even with the prices up. It's still cheaper to buy in 57% of the country, okay? Mm-hmm. This is what I personally would do, okay? So I own 50,000 houses, and I'm getting $2,000 a month rent for each one. I would go to all the people and say, so we have a two-tiered program for you. Mm-hmm. Tier number one is you pay $2,000 a month rent, mm-hmm. and you're a tenant. Tier two is you pay me $2,500 a month mm-hmm.
For
the first year,
mm-hmm.
and then it goes up the second year to some other amount. Mm-hmm. And then at the end of 2 years, if you meet this criteria, we sell you the house, but we finance it for you. We do the financing. Mm-hmm. And then all we do is whatever your payment is, so $2,700 a month, let's say, you then pay us that $2,700 a month. Mm-hmm. That way we save the whole having to get a loan and appraisal and all that stuff. You just buy the house from us. So it's basically seller financing.
Exactly.
They do seller financing. Now, why would they do this? And this is why. Seller financing is a higher interest rate mm-hmm. than if you went and got a loan, because the seller has to carry the mortgage and they have to take the risk. They have to take the long-term risk, because if prices tank, you can walk away. Mm-hmm. And if prices shoot up, you don't get to capture the higher value of the home, because people are going to be like, no, we need to make these payments because the house is worth way more than we paid, and we're only paying $2,700 a month. I think that's an interesting take on them doing that. The only other thing they would do if they wanted to liquidate the houses is they would sell the houses in block to another Wall Street firm. They would say, hey, we've got 80,000 houses in Tampa. We want to get out of that market. Who wants to buy them? And they'll mm-hmm. be like, oh, we'll buy them. And paperwork happens, and mm-hmm. but they don't hit the market. It's not like they just hit the market, 80,000. They don't just go and hire 80,000 agents to sell the houses. That doesn't work. That's part of what happened in the downturn, was when the houses got foreclosed, they went back to the banks, mm-hmm. and the banks hired agents like us, mm-hmm. which is how we sold 3,000 houses, and said, sell the house. And so what do? We stuck it in the MLS, mm-hmm. and everyone else was in the MLS, mm-hmm. and that the weight of all those houses in the MLS, I guarantee you that's not going to happen.
No.
It's not going to happen. So to go back to the original question, to me a crash is, I call it the 3-year rule. It has to go back below the 3-year thing. If you look at 2006, what prices were and where they were in 3 years later, 9, they were well below.
Right.
They went back well below. If you look back from 6 to 03 and then 6 to 09, so that was clearly a crash. That's a pretty good one. Pretty good crash. A correction, I think, is anything else. It's the market settling down. Mm-hmm. So it's a subjective thing, but mm-hmm. I don't think it's going to happen. In Vegas, I don't think it's going to happen. I don't think the market's going to crash. I'm going to give you some gouge or a word of advice. Business Insider mm-hmm. has predicted every year since 2017 that the real estate market would crash the next year. Like it's going to crash this year. So it went up 8%, it's going to crash, it's going to crash. They've been predicting it every year. And I remember running into somebody in like 2010, it might have been 9, and the values had really tanked. And they were looking, they had watched our video blog, and they came in the office. They were asking about some questions about buying, and I was trying to get them with a buyer agent. And ultimately what they said was, well, I think I want to wait a few years before I buy, 3 or 4 years. I go, why do you want to wait 3 or 4 years? And this was his answer. Well, a friend of mine is an economist at UCLA, and he said that specifically Las Vegas has another 15% downside in the market. And I think 2009 was probably the bottom of the market. So this guy probably waited till 12 or whatever, if he ever bought it. I don't know if he ever did. But the market never actually declined beyond that. Once it got to 2009, I think that was it. I think it was pretty much done. And it started, working its way back up as inventory got absorbed. And we were also told of these tsunami of foreclosures that were going to hit the market that never actually hit the market. They were just, Fannie and Freddie just sold them all in bulk to investors who did whatever they did with them. But we never saw the second wave of bank-owned homes that we were supposed to see.
Right.
So that's sort of I know this is kind of a long video and we're talking about a lot of things, but we want you to understand that we don't benefit from a crazy market like this. It's painful. It's really hard to do business. Ask any real estate how it is to do business right now versus the last decade. And they'll probably tell you that this is the worst time as an agent to be in the business since 2009 or 10. So at least the last 12 or 13 years. Right.
So we gave you some food for thought as far as the difference between a market correction and market crash. What's your take on it? What's your magic number? We've told you our magic number. What's your magic number for the difference between a correction and a crash? We want to hear from you. Whether you're a real estate professional or an investor or a homeowner, tell us what you think. What's the difference between a market crash and a market correction? Please like the video, subscribe, hit the notification bell, and we'll see you on the next video. Bye.
Bye.